A qualified personal residence trust, or QPERT as it is sometimes called, is an irrevocable trust that you set up for the purpose of transferring and gifting your personal residence at a discounted rate. The ultimate beneficiary of a QPERT is usually your children, but you retain a current interest in the QPERT for a term of years. Typically, this means you live in your house for something like 10 years, and then it passes to your children. Since the gift to your children is not immediate and of the entire house, the house passes at a discounted rate, requiring less gift and estate taxes be paid. So let's take a closer look with an example. This example is a bit ridiculous because the transfer tax system doesn't really work in the following manner. Nevertheless, it should give you a good idea of how QPERTs work. So, without getting into the complex calculations for future interests, I will just say that it would not be unusual for you to be able to transfer your home right now to a QPERT, and even though your house is worth, let's say, $1 million currently, it might be valued at only $400,000 for gift tax purposes. That means you effectively take $600,000 out of your estate, potentially saving hundreds of thousands of dollars in estate and gift tax. But you save in another way too. That is to say, even though it's not really been true lately, over time houses typically tend to go up in value. So, for example, let's assume your house is worth $1.5 million in 10 years, and you would have had to pay a 50% estate tax on that amount at the time of your death. You would have owed $750,000 in estate taxes without the QPERT, but since you already transferred the house in the QPERT and only paid a 50% tax on that $400,000 interest that was transferred, you only would have to pay $200,000 in gift tax. So, you saved yourself $550,000 in transfer taxes, which is the difference between the two taxes. Having said all of that, you should know that it is incredibly important that you not pass away during the term that you set for yourself to live in the house. If you do pass away during this time, your intent will be completely frustrated because the IRS requires that the entire value of the house be included in your estate. But there's a rub here, because you want as long a time to stay in the house as possible, since the longer you stay, the greater the value of your retained interest, which means you are transferring less to your beneficiaries. In other words, the transfer tax cost is effectively lower the longer you stay in the house. If, however, you guess wrong and you pass away during the term of years that you set for yourself, the entire house is pulled back into your estate. There are yet even a couple more things to be cautious about too. First, you should know that using this strategy might cause you to lose out on other important income tax benefits. And also, you need to realize when the QPERT term expires, you cannot live in the house any longer unless you pay fair market value rent to your beneficiaries to live there. So as you can begin to see, the decision to use a QPERT is a highly personal one, and you will want to analyze a number of factors, including your age, your health, your assets, as well as current and prospective estate tax exclusion amounts, to decide if it's right for you and all that you must give up to potentially get its benefits. If you are interested in finding out more about QPERTs, please make a free appointment here at the Trust Store.